Our first speaker this morning, Michael Ryder with OMERS Infrastructure America. He is joined with NCPERS board member Rick Miller to discuss infrastructure investments and in particular how best U.S. mid-market plans can invest in this asset class. Please welcome Michael Ryder and Rick Miller.
Thank you, Tina, and Hank for inviting me to speak today to you on behalf of OMERS. My bio's up there. Maybe let me just work out how to move us forward here. Many of you know OMERS as we've presented at NCPERS in the past. I believe we have an interesting story regarding our experience investing directly in infrastructure that I'd like to briefly share with you. I'll also touch briefly on the current state of the infrastructure investment market, and then would like to share an overview of a recent investment program that we led as an example of how we have provided creative solutions to interested pension investors such as yourselves. So who is OMERS? We are a $95 billion Canadian defined pension plan focused on direct investing, different from most of the US plans in that regard. We manage the pension assets of almost 500,000 members who are municipal employees of the province of Ontario in Canada. As I mentioned before, we do not invest through third-party funds, but have approximately 120 professionals focused on directly investing our assets across a diverse portfolio of infrastructure, private equity, real estate, and the capital markets. We're proud of our performance. Last year, we generated a total net return of 11.5% for our members, leading our Canadian peers, and we believe supporting the direct model that we have pursued over the past 20 years. Talking a little about infrastructure, why do we like it? Most importantly, we believe that the long-term nature of infrastructure assets provides a very good match with the duration of our pension liabilities. As I'm sure many of you share, our average payment obligation to our members stretches out over 20-plus years. The strong, predictable cash flows generated by infrastructure assets over a long time horizon are a very good match for these liabilities. Secondly, we look for assets with strong market protections, regulations or contracted demand profiles that mitigate risk in our portfolio. Infrastructure assets are also, by their nature, an efficient inflation hedge, with revenues and costs that generally go up in inflationary environments, mitigating our portfolio exposure to the long-term risks of higher inflation. Finally, and importantly, we are committed to responsible ESG principles and believe that by managing our investments directly, we are well placed to maintain these standards. OMERS has approximately 20 years of experience directly investing in infrastructure assets. We believe this experience differentiates us from most of our competitors and other sector investors. We are well known in the market as strong partners with both corporates and other investors, and have developed positive relationships with regulators and local governments in the jurisdictions where we own assets. All of these factors, combined with our long-term approach, position us to be an acquirer of choice when we talk with owners, partners, and other stakeholders. We leverage these differentiators to identify and secure the best investment opportunities in the market and provide superior returns for our members through the investment cycle. In parallel, we carefully manage the risk in our portfolio through diversification and active asset management focused on long-term value creation. To give a sense for the portfolio we own today and demonstrate the diversity, we own companies and assets around the world in multiple industry segments. In the US, we own the largest gas-fired power plant in the country, MCV, over on the left, a share in a toll road outside Chicago, Skyway, and a stake in a large Texas power utility, Oncor. In Canada, we own Life Labs, a medical labs business, TerraNet, a land registry, and Bruce Power, the largest nuclear power plant in the world. In addition, we own a significant stake in a liquefied natural gas facility serving Santiago, the capital city of Chile, which was our first investment in Latin America. In Europe, we own a stake in airports, the main London water utility, a portfolio of ports, a number of electric and gas utilities throughout the continent, a highway concessions business, and gasoline terminals in certain parts of South Europe. Finally, in Australia, we own a minority stake in the Port of Melbourne. This portfolio is highly diversified across geography, asset type, and industry sector, providing significant risk diversification for our overall infrastructure portfolio and for our pension plan members. So that's an overview of OMERS. Let me turn briefly to the state of the current infrastructure investment environment. You can see on the left are a number of macroeconomic factors that are buffeting the market today. Political uncertainties, slowing GDP growth, inflation, tax changes, all making investment today more challenging as we approach the top of the current cycle. We actually believe this plays to our strengths at OMERS. To be a successful investor in any environment, it is important to avoid mistakes. But today in particular, we need to navigate peaking valuations and a greater risk of a macroeconomic shock, and the wide availability of low-cost debt. Despite all these factors, I'm not a timer of market cycles and seek to make investments through the economic and market cycle for the benefit of our members. It's important in a time like this not to be afraid to invest, or we will risk missing out on good opportunities. We must balance our risk tolerance, look for good investments that will generate attractive returns for our members in the long term, maintain our discipline, and diversify our investments, as I showed in the previous page, across sectors and regions. And we must focus carefully on managing our existing assets, almost $20 billion worth today, to minimize risk in our portfolio. As a highly regarded investor said recently, we must move forward, but with much caution. Turning to the US infrastructure market, the US infrastructure market needs our help. Despite record private sector fundraising for infrastructure in 2017, we have a $2 trillion funding gap over the next 10 years, according to the American Society of Civil Engineers, costing American families $3,400 a year and over 2.5 million jobs by 2025. The money is available. Both international and domestic investors have increased their allocation to infrastructure during the past few years. OMERS itself is targeting more than 20% of our portfolio towards the infrastructure asset class. But access for private investors has been limited by regulations and community sensitivities, and we have, as a result, primarily had to focus on sectors such as energy, power and gas utilities, and the communications sector, where private ownership has been the practice for decades. With the high need areas such as transportation, our roads, airports, and ports, and social infrastructure, our schools, public housing, and the like, private capital has much less success. OMERS itself has invested in public housing and schools in Canada, where we've had some success over the course of the last 20 years. Unfortunately, with the lack of progress in Washington on the infrastructure bill, the opportunity to leverage private capital and pension capital to address our infrastructure challenges remains largely untapped. Finally, I'd like to share with you an example of the creativity that we believe OMERS has brought to the market in recent years. In 2012, we launched a unique program, the Global Strategic Investment Alliance. It offered investors such as yourselves the opportunity to participate in a co-investment program alongside OMERS in a number of our largest transactions. The program ran for 5 years, actually finished early this year, and resulted in excess of $5 billion of investments by Alliance members globally, including a number of the transactions I touched on in my earlier slides. OMERS is a strong supporter of these innovative type structures that can leverage our direct investing experience and help and partner with like-minded organizations. We would expect to see similar types of programs such as this in the market in the future. So this just gives you a quick overview of who we are and our current perspective on the investing market. I'll now join Rick and look forward to discussing his and your questions. Thank you very much.
Very much for that, Michael. It's on? There we go. So, Michael, I guess I want to, before I open it up to the floor for questions, one of the questions that I wanted to ask you is that there's a lot of capital going into this asset class, and you mentioned the high valuations with a number of these assets that are available or existing assets. Can you address for the audience any concerns regarding, this large inflow of capital, plus the high valuation and the risk that could be associated with this?
It's a good question, Rick. Look, there is significant equity and as I mentioned, low-cost debt available in the market today at this point in the investment cycle, and it does increase the competition for deals. I actually think it's a positive. It's brought a lot more sophistication to the market, and as a result, we may see less mispriced or sort of extreme return deals going forward. But there still remains a large untapped need for capital in this sector. I mentioned the $2 trillion of investment gap. I think the key to success for us and for other investors who are looking to deploy capital in infrastructure is careful, disciplined investing through the cycle. And that comes with experience. We've been doing this for 20 years. A number of my peers and colleagues have similarly had a long track record. And so although right now where we are in the cycle, you have to be increasingly cautious, infrastructure is a long-term investing profile. It's not market timing. And so being careful about where you deploy capital and carefully screening, and then importantly being very disciplined about how you manage assets is the key to success.
Thank you. At this time, I'd like to open it up to the floor as well to engage with our panel here. So are there any questions from our members? Please feel free to put up your hand or raise your question.
We've scared them all off, Rick.
I know we're from Canada,
Or Australia, actually.
No, are there any other questions from anybody? We got a microphone here on infrastructure over here.
Do you want to wait for a microphone?
They want to hear you, Sharon.
Wow. I was just wondering about the 20% allocation, because for a lot of our funds, that's 20% is big. So can you just talk about, why and sort of the function that 20% allocation plays in terms of your overall portfolio and recommendations you have for the U.S.? I know we're behind the times, Rick. I know that we need to do more, and I think we're trying, but it's, so I just wondered if you could talk about that percentage, because that seems high to my ears. Thanks.
Sure. It's a good question. And look, on a relative basis, 20% is high. And so you're absolutely correct. I think I had on the slide, at least I had on a previous version, that pension plans generally are moving towards sort of a 5% allocation to infrastructure as part of their broader portfolio. The OMERS model has, and our strategy has evolved over the past 20, 25 years to fully direct. And we have a significant allocation to private markets, about 40 to 45% of our portfolio, which is meaningfully larger than many others. But we believe, given the amount of investment that we've put in that strategy, including the 120, 130 people focused on infrastructure and private equity, and then a pool of people also focused on real estate, that we have the expertise and the skill to be able to do that. And it provides us, as I said, a long duration set of cash flows that we feel very comfortable with. We can manage through the cycle. The rest of our capital, circa 55% today, is allocated towards capital markets, and both on the debt and the equity side.
One thing I'll also share with you, Sharon, myself being the former chairman of the board, Our board, a number of years ago, as Michael said, it's grown and evolved to get to where it's at, and it's progressively grown each year. As we looked at our demographics, the age of our membership and our actuarial liabilities, how do we best match our liabilities with the returns and, of course, with the growth and the experience of our staff in those private asset classes? That was kind of all working at the same time. So it was, taking into account that, and also the volatility of the public markets. We all know what we went through in 2008 and 2009, and that was a wake-up call, and said, how do we mitigate another 2008, 2009 timeframe, and that kind of a negative market experience? And a lot of times you just didn't have those controls with the public markets. So again, that was some of our decision-making at the board level, to move to that higher allocation to the infrastructure asset class and our other real assets. Other questions, please?
Yeah, hi, good morning. Will you please comment on the process of bringing investment in-house in terms of compensation and independence of your investment staff versus managing that process externally? Thank you.
So I mentioned we have a significant staff that's focused on the infrastructure space, and I'll talk about that specifically. The team runs quite independently. We operate as a group very, very similarly to any of the third-party funds that you may invest in today. As I mentioned, we have a strong reputation, and we rely on our relationships and partnerships that we've built over the past 20 years really to source opportunities. The decision process and the governance process around deciding on investments is very critical. The team itself can spend multiple months working on a particular opportunity. We'll develop the business case associated with that. And then the initial screening and review is at that team level. And then as an advisor to the pension plan, we bring those opportunities to the executive committee and then ultimately the board, of which, as Rick said, he was previously the chair, to decide if they wish to move forward with an investment. So the final decision process is actually made by the executive committee and the board of the pension plan. The team itself makes recommendations and does the work in order to support that decision.
And I think you mentioned the word compensation as well. So, you're nodding your head. I can tell you, from the board perspective, when setting our compensation, it's linked to pay for performance. We establish compensation systems with our advisors from the board, getting long-term incentives, short-term incentives, and paying our employees well to deliver the results that we need. And we incent our employees to pay for performance so that our members, I used to have an old saying, when we eat hot dogs, you're going to eat hot dogs. When we eat steak, you're going to eat steak. We're going to share together. It's never going to be the other way around. Because, again, it's incenting our employees pay for performance. And that's the compensation design that the board set up years ago as we moved further into our direct drive strategy. There was somebody else had a question? Over there.
Good morning.
Good morning.
Morning.
When you do infrastructure, you partner with other pension funds, I understand. Is that correct?
We do, yes, ma'am.
Okay, so how do you determine the return to each fund when you do the partnership? And how do you determine, if you merge with them, then how do you determine how much each fund and yourself are going to get? Is it split 50-50, or is it a percentage rate, or is it, you understand what I'm saying?
I do. It's a great question.
Talking to you.
So, look, we look for and source opportunities sometimes on our own, and in those situations we might invest 100% in a transaction. We did that in a recent renewables wind energy transaction that we announced earlier this year. And in other situations, we'll partner with like-minded investors. Frequently, they might be the other Canadian pension plans, or as I mentioned on the GSIA program before, we have partnered with similar pension plans to some extent in the U.S. and also internationally. To very directly answer your question, it depends on the situation. We ensure that all of the partners are aligned. So we enter at the same time, we enter on the same terms, and as a result, we should all experience the same return profile from a particular opportunity or investment. Whether we own 20% or whether we own 50 or 75% is really a discussion with the partners as to who may have the greatest value add in a particular situation, and how much each individual partner may want to allocate. We frequently and ideally prefer to have a significant position, so we're less likely to own 10% of an asset, but we might partner with two others and own a third. Does that answer your question? Thank you.
Somebody else had their hand up? It's hard to see. Over to this gentleman here.
And bringing the mic.
Dealing with infrastructure, every time we have a storm here, in the east especially, right? We have Westchester County, everybody's lights go out. Isn't that a huge opportunity for infrastructure to put these lines underground?
I have a house in Westchester County, and I know exactly what you're talking about. We've invested in a generator a couple of years ago because we just gave up on the fact that every winter storm and almost every summer storm we'd lose power. Yes, look, there is a huge opportunity for infrastructure investing in this country. It's greater in opportunity than almost anywhere else in the world. The challenge has been navigating through local government, state government, and then ultimately federal government, but it tends to be local and state more than anything. Regulations and legislation in order to be able to invest that capital in a way that is fair and reasonable for ratepayers in the case of the utility situation, while also providing a reasonable return to the investors that in most cases, like ourselves, are ultimately pension plans or something similar. So I'll be very, very specific on Westchester. But this applies to almost any utility around the world. The cost to put all those wires underground is significant. I'd be very interested in investing in it. The challenge for the power utilities is getting in front of the PUCs, public utility commissions, and justifying that capital expense and generating a return on that capital expense in rates. And rightly or wrongly, there is a reticence to increase rates in order to support those types of capital programs. And I think, unfortunately, out of desperation, we'll ultimately do it, and it will probably cost more. But that's been the challenge over time. And in some jurisdictions, in some states, Public Utility Commission are state-based, as I'm sure you all know. There's been more willingness to do that, and there's been a greater investment, and the reliability is higher.
So, Mike, since you're talking about infrastructure here in the U.S., what's the likelihood of a bill coming out of Washington for infrastructure? You hear a lot talk about it and so on, and you speak to a lot of people as an organization, both at the government level and private sector. What's your thoughts on that?
Look, it's disappointing. In the primaries in 2016, a lot of people talked about infrastructure bills. As we went through the election process, there was a lot of discussion of infrastructure. DJ Gribbon was brought into Washington, a former infrastructure investor, to lead the initiative to develop the bill, and it had a lot of bipartisan support. Unfortunately, it fell in the priorities of this administration, and as a result, at this point, I think the outlook is pretty dim. For a comprehensive bill in the near term, it's unlikely. Maybe something happens between now and November, but I think it's doubtful. And post-November, I think it will be next to impossible once we have the interim elections have gone through. So The administration has other priorities. Despite the bipartisan support for an infrastructure bill, it seems to have lost momentum, and I doubt we see anything in the next 2 to 4 years, 2 to 3 years.
Other questions from the floor over here?
Hello, good morning. I'm Wayne Moore from the Los Angeles County Employee Retirement Association. Could you run through a couple of examples of investments that you've made and how the money was deployed and then how you received your return over what period and how you generated it?
Sure. I'm thinking through the investments in our portfolio. Let me start with an interesting one, which is Bruce Power. So Bruce Power is today the largest nuclear power plant in the world, and it generates about a quarter of the province of Ontario's power. So it's significant. We are a 50% owner and a partner, hand-in-hand partner with a corporate as the other 50% owner. We bought that asset from an international utility. It was actually a British-based utility in the early 2000s when that utility had financial challenges. This asset was operating very, very well. It has a long-term power purchase agreement contract with the Ontario province. And they saw this as an opportunity to monetize the asset so they could pay down some debt in their home country. As a local pension plan, we led a lot of the dialogue around the acquisition. We evaluated carefully, and we were able to come in and pay a fair and reasonable price in partnership with our corporate partner. And over the last 14, 15 years, we have benefited from significant cash flows off that asset. The asset itself, to give you a sense, generates almost $750 million a year, which is a huge cash flow stream that comes back to us, enabling us to pay our members' pensions. We're actually entering a program over the next 10 years to repower that asset, so the cost to ourselves and our partner will be approximately $10 billion over the next 8 to 10 years, and as a result of that repowering, somewhat like investing in Westchester Electric Utilities, we will have another 50 years of life in that nuclear power plant, and we'll continue to benefit from the returns for ourselves, and the Ontario province will continue to benefit from what is a very, very low carbon footprint that they have in that province. They're one of the lowest carbon footprint jurisdictions in the world. So that's a good example. It's been very successful, and we're very, very proud of it. I'm trying to think of another good one. We have in the U.S., I'll pick a U.S. situation. We invested in 2012 in a toll road outside of Chicago called Chicago Skyway. It's a 10-kilometer, about 7.5, 8-mile toll road. We invested in that asset just as it was being completed construction. There was some expansion that we invested just after that. And we have maintained that. We own it with 2 partners. We've just been investing in automated meter tolling payment systems. And we have a very, very good relationship with the local regulators and the Department of Transportation in Chicago in terms of running that asset and continuing to maintain it in a strong way. I think there might be some opportunities actually for us to further invest in that asset to expand its capacity in the coming years. That one as well has generated nice cash flow for us, not quite as much as Bruce Power, but it's generated a strong sort of 5% yield, and the capital that we've been investing has been accreting as well over time.
Private equity model where you make an investment and then you get out of that investment in some exited in, I don't know, 7, 10 years.
Understood. So just for everyone, because I know that you missed the beginning, you said that those are more ownership, long-term ownership type strategies rather than necessarily exiting. So we've been investing in infrastructure for just around 20 years, and last year was the first time we sold anything. We are long-term investors, and I said that as I was speaking. I probably didn't emphasize it enough. It is a big difference in how we approach investing relative to many of the traditional private equity or infrastructure investor funds that you might partner with. We sold a stake in a rail entity in the UK last year. It was just an incredible opportunity to sell at a great valuation, and so we decided to do it because it was a good return for our members. And then this year, actually 2 months ago, we announced the sale of another portfolio because it was taking a lot of time for us to work with it, and we also got a great price, and we're able to generate a 14% return over 9 years. But generally, we're not sellers. We're long-term buyers and owners of assets. We're strategic partners for companies that have long-term horizons. We will be opportunistic about taking advantage of someone else coming in who we think is perhaps overpaying or has a strategic rationale for owning it that's stronger than us. But we're not the traditional buy and flip type guys.
Well, I got to wrap it up now, and first of all, I would like to thank Mike for your time today. Michael, great job, Michael. And also, I'd like to thank all of our members for your participation in our panel today, and enjoy the conference. Thank you.
Thanks very much.